to market functioning, that's also something that the Fed does not want to lose control of.
Do you have a level of rates that would be appropriate? You know, we've talked about your rule, which is more about when recessions are onset, but how would you know where the right level of rates is?
Right. So the economy is always evolving. There is no one magical number. I will say that for each rate cut that the Fed goes through, raise the bar for the next cut. Right. We are in an environment where inflation is elevated. Right. And so as the Fed is cutting, it's removing restriction. And you have to keep going down that path. You have to be comfortable with the idea that, well, whatever extra inflation we have right now is going to kind of take care of itself.
Understood.
So whereas I'm in favor of cutting today, that doesn't mean the idea that like let it rip and just keep cutting. Right. You're going to have to keep evaluating that.
Claudia Sahm, thanks for making the time. Exactly the person to check in with on Decision Cut Eve. Claudia Sahm, New Century Advisors. Our Fed coverage continues on Power Lunch. I'll join Brian Sullivan for that right after this quick break.
Well, happy Fed Day and welcome to Power Lunch. We are less now than 5 minutes away until the Federal Reserve makes a call to likely lower interest rates or does not. The odds of a rate cut just under 90%. So the market is expecting a cut. So if we do not get one, stocks, they could fall. Or if Jerome Powell's comments about the future of rate cuts are not as optimistic or as bullish as some expect, stocks could also fall. It is arguably one of the most impactful potential meetings in a long time. And ahead of it all, here's how the markets and your money are setting up. And as you can see, no big positions being taken either way. Dow's up a touch. S&P and NASDAQ are down a touch. Stocks mixed. Investors, traders really all in a holding pattern ahead of that Fed. Bond yields, they've actually moved a little bit up into this decision. 10-year rates a little bit down now, but we were just at 4.2% yesterday. And by the way, the average mortgage rate in America, 6.19%. According to Fannie Mae, because you may not care about what interest rates are, but you might care what borrowing costs are for either a house or a car. Kelly Evans.
You absolutely do. Real quickly, there is a standout in the markets today. Don't lose this one. GE Vernova is up 15% pretty much to a record intraday high. The best stock in the S&P, shares have more than doubled this year. The company issued strong guidance at its investor meeting. That'll do it. Key to that guidance, Brian, multi-year demand for electricity from some of the world's biggest tech companies. This is one of my favorite stories. We don't have time right now, but the GE spinouts and how well they've done. Vernova, which was supposed to be a wind company, now is doing as well as it is fascinating.
Well, turbines. All the money is in turbines. You want to power that through a pipeline, through a natural gas power. I love that everybody is suddenly now interested in energy. All right, let's get right now our all-star Fed panel. Set you up not just for today's decision, but also the markets and meetings ahead in January, March, and April. Very pleased, as always, to be joined here in studio. David Kelly of J.P. Morgan Chase, Francis Donald of RBC Capital Markets, Jim Karen of Morgan Stanley joining us remote. Jim, welcome as well. Francis, I'll start with you. Your expectations for today.
They're going to cut, but I got to tell you, today is not about this Fed decision for me. It's about what it continues to reflect about an incredibly complicated economy. We have very limited data visibility. We know that employment is softer, inflation is rising, the economy is fragmented into that K-shape we all know about now, and let's not forget, we have a once-in-100-year trade shock. How is the Fed going to explain all of this to us, and how are they going to set us up for 2026 in an economy that is decreasingly interest rate sensitive and yet still has its firm eyes on what Powell or Powell's predecessor does next?
Would you consider David Kelly today to be what they would say is a hawkish cut, but with cautious language?
It's kind of like when parents give a kid, okay, you can have one more cookie, but this is the last cookie.
It never works
until the next one.
No, well, exactly. But I think there's going to be it's going to be a cut. We could get multiple dissents here, and I think they're going to really push it out and say, don't expect another near-term cut.
Jim, I don't want to look too far ahead of today because it does matter. 90% chance of a Fed rate cut today. Looking at the CME FedWatch tool, you got about a 25% chance in the market of a rate cut at the January 28 meeting, first one of next year. Where do you land on the next possible cut?
So on the next possible cut, it's going to be all dependent on what happens in the labor market. The labor market is really the key messaging for the Fed. The Fed has to be careful, though, right? It doesn't want to walk into a policy mistake by being either too hawkish or too dovish, because the path of least resistance right now is towards higher bond yields, which is not necessarily effective or a good thing for markets. So if the labor data continues to weaken, if it softens further, then I think January is very much on the table. If it doesn't, then we're going to kick the can down the road.
Yeah, we're going to find out here in about 15 seconds. Like we said, it is a mixed trade. You got the NASDAQ slightly down, the Dow slightly higher, the 10-year yield right around 4.16%. Let's go now to Steve Leisman on the Fed's decision on interest rates. Steve.
The Federal Reserve reducing interest rates by an expected quarter point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Smith, his second dissent in a row. Also, another dissent for a 50 basis point cut from new Fed governor on loan from the administration, Stephen Myron. To recap, the vote was 9 for cutting a quarter, 2 against cutting, 1 for cutting 50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up 0.5 point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated. Economic uncertainty also elevated. Back to the Fed outlook and the dot plot real quickly here. Only 2 dissents, but 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft dissent in that regard, you can call it. 7 want no change at all for next year. 11 only want 1 cut next year. One person, and we can imagine who that is, Stephen Myron, just guessing here, wants rates down to 2.12% next year, or 150 basis points lower. And that is the statement and the outlook for rate cuts and the balance sheet. Mr. Sullivan.
Quickly, sir, you said buying bills maybe sooner than the market expected. This is not QE. I do not dare call it that. But is this like the son of QE, quantitative easing light?
You know, Brian, people are going to take off on this, and I don't want to stop the craziness that'll happen in social media and on the interweb. The Fed will say this is maintenance of its balance sheet at a level of GDP of where it was. Some people, however, will call it QE light. Some people will call it son of QE. I believe the Fed will say this is neither, that this is simply maintaining the balance sheet at what they call the ample level of reserves, and that will cause them or prompt them to begin buying $40 billion of bills. It looks like 3 years. They also may go out a little bit into the bond market as well, but they want to stick to the short end of $40 billion a month until about April, when they say there'll be a sharp decline in there. And Brian, call it what you will.
Let's see what Rick Santelli calls it. Steve, stay right there as you continue to dig through this. The market reaction initially showed a very dovish tilt. We have stocks moving to session highs. We have bond yields falling. Rick, your interpretation?
Well, my interpretation, Steve nailed it. I don't disagree with social media going hog wild. They could put any spin on it they want. Ample reserves to deal with the reverse repo market issues, but it is QE, call it QE light. And once again, I have an issue with this, and my issue is simple. Every crisis, they expand the balance sheet by buying securities to manage rates or manipulate rates. Pick any M word you want. But in the end, this is something to really pay attention to. And finally, the markets themselves, we saw a couple of basis point drop pretty much across the whole curve. 358 down to 356 in a 2-year. 10s were hovering right around that 416 level. They dropped about 2 basis points to 13 and change. They're right back to 415. What's notable is where we were this morning, as Brian pointed out, the fact that we're toying with 420. Remember, we closed at 457 last year. We're getting ever close to unchanged on the year. On a year that many analysts and experts thought we'd be spending a boatload of time under 4%. We've had a total of 8 sessions close under 4% so far in 2025. The dollar index, no surprise there. It's down about 1/3 of a cent. It was down about 1/4 of a cent before the statement was read. It's definitely toying with this 98 3/4 to 99 level. It seems to have lost its hunt for 100 recently, but that makes sense considering the Fed's easing. And finally, the next meeting, January. Many are talking about the January 28th meeting. For a while today, we had about a 30% probability of a 1/4 point ease. That's now moved to around 24%. It's been bouncing around a bit. If you look at the March 18th meeting, that's also hovering around a 25% probability of a 1/4 point cut. But basically, the real issue for 2026 is how much the market's going to pull out on the easing mentality as we continue to get data that certainly doesn't look like the labor market is dying a quick death. And in terms of inflation, not a lot's changed in the last 16 months. It's sticky, and it doesn't seem to be coming down closer to the Fed's target.
Rick, appreciate it, and we'll circle back in a moment. But let's get more from Mike Santoli. Mike, on what jumps out to you about the market's reaction here and what the Fed just told us.
Yeah, sort of net positive. I wouldn't say it's a real vociferous reaction. Obviously, it's during the press conference that we sometimes get more of the swings or the rethink or the unwind of the unwind. We know the drill on Fed days. But there has been a value over growth, cyclical stocks over defensive stocks, financials leading, especially banks. That has meant that the market has been kind of revving in this direction of anticipating a firmer economic performance in the early part of next year. We could be proven wrong on that, but the market seems pretty resolute in trying that hand. And I don't think that today's cut and going on hold because we weren't priced for further cuts in the coming months is necessarily enough of a surprise to disturb that in any respect. I mean, if Fed was on hold from December of last year till September of this year, and we had other things moving the markets around, but it was not really a rates issue. So the longer term coming in a little bit in yield, maybe that does loosen things up a little bit, although I wasn't particularly alarmed at the level that long-term yields had gotten to in this run.
All right, Michael Santilli. Michael, thank you very much. All right, let's go back now to our panel. We got Jim, Francis, and David. Francis, I want to go to you because let's talk about the job market, and I'm going to compare the last meeting minutes, and you'll forgive me, I got to look down and read it. Here's what they said at the last meeting minutes about the job market. They said the unemployment rate is edged up, but remained low through August. So they said, oh, okay, it's edged up, but it's low. This year, first paragraph, the unemployment rate has edged up through September, hard stop. So they seem to be acknowledging that the job market has weakened a little bit. I guess that changes the odds of a potential rate cut.
I like your word a little bit, because if you look at a chart of the unemployment rate going back to the 1970s, it's only been this low 2 times over that period, Brian. So I'm wondering why this is suddenly not low, particularly that we've only seen what I would consider a normalization in the labor market. In particular, this hasn't been broad-based across all age groups. It's been really focused on young individuals in the United States. So is this really a labor market that's quickly deteriorating? It doesn't look much like that much-feared hockey-shaped movement to me. Meanwhile, inflation has been above target for 55 months. So if I was looking at the bulk of the data and I looked at that dot plot and I looked at the Fed's forecast today, I would be saying, oh, they must have decided to hold or hike in that type of environment. What I want to hear from Powell during this press conference is, how the heck did you convince this committee to end with a cut today?
David, did they convince it? We had 3 dissents.
Well, no, and it sounded like we could have had 6
More.
dissents.
6
dissents.
They dissented on what they call the dot plots, which I hate that term. It's like the Fed's light bright, where they put in where they expect rates to be. 6 non-moves on that, 3 actual dissents. So 3 people, I'm sorry, I'm going to say this, 3 people chickened out. Well, they wouldn't go on the paper and say, I disagree.
Well, exactly. And you can see that from the language in some of the speeches that we saw after the last Fed meeting, which actually convinced markets they weren't going to cut today, because some of particularly the regional bank presidents, are really hesitant to cut, at least in what they say. But then when it comes to it, they give the kid another cookie. And actually, it's a slightly bigger cookie than expected, because they got this extra liquidity for the short end. But I do think this is more dovish short term, but still pretty hawkish long term, because if Steve's reading of this is right, they've upped their estimate of GDP growth next year by a lot. We've got all these income tax refunds that are going to kick in the first half of next year. That's going to push growth higher, regardless of what the jobs market is doing right now. And it sounds like there are very few members of the Federal Open Market Committee who want to do more than 1 rate cut next year. And if you're only going to do 1 rate cut in the year, when are you going to do it? Maybe you wait all the way until December. So we're going to have it's going to be interesting here with the Fed perhaps going on pause in the first half of next year.
All of that said, maybe we can put this on the screen. The tech ETF, we were talking about this yesterday on a 12-day win streak. Well, it's now in the green after this move up to possibly have a 13-day stretch that would be its longest in about 8 years. So that's meaningful. We also have silver and gold on the positive and on the rise. Jim Karen, I was just going to bring you in on this because it seems, and I think John Spallanzani's phrase captures this perfectly, that he calls it, says the repo vigilantes won. Because the big headline for a lot of people, even those who are more bearish on bonds, is the Fed's back, they're buying, and they're doing so. Maybe it's just bills, but it's significant that this action is now coming a little bit more quickly than people thought. What does it tell you?
Hi, Kelly. Listen, I think that's a great way to frame this. On balance, this to me is a more dovish meeting. Now, yes, it is true. And I would really say that this is ironic, right? And I think we have to see the irony in this. The Fed has basically raised the bar for the next rate cut. right? So we still think they're going to cut, but it's going to be a higher hurdle for them to do that. However, they did surprise the market on the dovish side by moving that balance sheet management from what many people thought was going to be early next year to actually what's going to happen starting, right now here in December. The Fed is basically telling us that they want to have pro-cyclical policy, meaning they want to support the growth cycle. They're going to stand at the ready to cut interest rates if the labor market deteriorates further. And at the same time, they're worried about liquidity. They want to add liquidity back to markets. Call that reserves, call it what you will. The point, though, is that we need to get over the year-end turn, right? So liquidity constraints might come in at the end of the year. And the Fed wants to avoid that type of a stress in the marketplace. So net, the fact that they're willing to start to inject this liquidity, worry about reserves, and that's a lot of what's going to maintain, I think, some of the bullish sentiment in the markets, which is what we're seeing reflected, is actually the net dovish component, even though they raise the bar for the next rate cut. So I think it's a bit ironic.
Well, also, Jim, back to you, because a lot of people are listening or watching at home going, all right, this is great. What do I do? Well, to Kelly's point, the NASDAQ ticked up, the XLK on pace for its 13th straight day of gains. That would, I think, tie for an all-time record, or at least going back the 8 years. Why did stocks move up if prospects for more rate cuts went down?
Yeah. So effectively, one of the big concerns that was in the marketplace was that the Fed would have very inflationary policy, that they would be dovish and that they would push these long end rates higher because whoever the next Fed chair is, could potentially cut rates a lot. What the Fed is telling us right now is that they're not willing to do that. So what that's doing is it's stabilizing the back end of the yield curve. It's allowing the equity markets now to say, oh, we don't maybe have to worry so much about this inflation impetus that might come out of a Fed that's too dovish. So again, ironic. And that is actually something that's very supportive for the equity markets if rates stay relatively stable and well contained.
Yeah. And Steve, you want to jump in here?
Yeah, I wanted to back up what Jim was saying about the dovishness of the balance sheet decision. We asked in our Fed survey, which we released yesterday, about the balance sheet expectations, and it was for purchases to begin again in April. So this is quite a bit earlier, and for purchases to average just about 28 or 30 billion. So this is more than that. So on that front, for sure. I would also point out that when I'm looking at the immediate reaction of the market, it's a little bit more dovish in terms of that next rate cut. We had it more fully priced in for June before the statement came out, and now it's about a 57, 58% probability for April. That's going to bounce around. And all of that said, this entire discussion, I would point out, may go out the window next week when we get October and November employment numbers, as well as some inflation numbers, and we'll figure out if the Fed made the right call here and whether or not the forecast is worth either the paper that was used to print it or the digital space it's taking up on the web.
That's an excellent point. As always, Steve Leisman. Francis, the Fed has two mandates. I mean, people forget about that. We always talk about inflation because of what happened during COVID and prices spiked and inflation was 9%, blah, blah, blah. But they also have the jobs mandate, maximize employment. How do we read the jobs part of the picture vis-a-vis what the Fed may or may not do?
Yeah, I've been thinking a lot about this because I keep wondering to myself, how can you be cutting interest rates when inflation is this high and per our forecast going to be heading higher? In fact, it's really hard to see when that next cut is going to come through. I have to agree with David here. When is the window to do that? Because by February, we see that inflation side moving higher. And yet, Brian, this is not interest rate driven inflation. This is tariff level inflation. This is inflation that is coming from a labor market that is shrinking, immigration, retirements that are coming through. And part of me wonders if this Federal Reserve is saying our interest rate policy is far less relevant to the inflation side of the picture than it is to the job side.
Okay, let me follow up with that. Do we ignore, I hate to say this, do we ignore inflation? If exogenous factors, tariffs, whatever, are contributing, labor costs during COVID, whatever, if they're contributing to inflation and there's nothing the Fed can realistically do about it, should they cut rates anymore at all?
Well,
why not raise rates?
Here's the rub here. The problem is if they don't actually contain inflation, it can spiral out of control. So you start with tariff level inflation, you start with some wage pressures that sort of create a floor underneath. If you don't respond to it properly, if you're too easy, then that can start to spiral. But there's another elephant in the room here, which is that we have phenomenal amounts of fiscal spending. And how funny it is to me that we spend so much time attributing monetary policy to inflation, and we forget that expansionary fiscal policy is also very very inflationary. So the forces on inflation are wide ranging and shouldn't just go to the Federal Reserve policy. So it's not a surprise to me that their bias is towards the labor side of the mandate.
Well, I think the other part that we're not talking about is just how high the equity market has been. I mean, this is the end of 3 booming years for the equity market. And I personally don't think the Fed ought to be cutting aggressively or at all right now, but it's not because of what they're going to do to inflation. Or
so you would have dissented. You would have, you would have not have cut rates.
I would have dissented, and I would have voted the way I did with what I said, because the problem is that they have caused asset bubbles over the years by keeping rates at an unrealistically low level. And I think the danger is they're just going to cause another asset bubble. And when these bubbles burst, they cause tremendous damage. So there's nothing wrong with a federal funds rate at 3.75% to 4%. I think that's okay. The economy should be able to do.
The president would disagree because people want mortgage rates to go down to 5%.
Well, the mortgage rates, long-term mortgage rates are determined by the 10-year, not short-term rates. And if you scare people about inflation, or indeed if you cause a booming stock market, that actually will probably help keep those long rates higher. So I don't think, anyway, why do we have a housing problem? It's not because mortgage rates are too high now. It's because the mortgage rates were way too low for a decade, and that caused prices to spiral out of to a level that people can't afford.
Who kept them low? Who kept them?
Well, the Federal Reserve.
There you go.
No, exactly.
Thank you.
But that's exactly my point. The Federal Reserve should aim for a relatively neutral level of interest rates, and honestly, that's where we are right now.
I'm going to paraphrase Animal House. You screwed up. You trusted us. David Kelly, Francis Donald, Jim Karen, Steve Leishman, thank you all very much. All right, let's get another check of the bond market because, Rick, as David just adroitly pointed out, the bond market is going to determine rates, not the Fed.
Well, quantitative easing would argue with you. The market can only do so much. If the Fed starts pulling out securities from the marketplace, affecting supply and demand, it does make a difference. Now, to that end, the yield curve is steepened a couple of basis points. Now, I understand many out there are saying, well, a couple of basis points, but it is significant how it's doing it. So a 2-year note right now is almost exactly 2 basis points lower than before the statement. The 10-year is exactly the same. Arguably, the yield's a little bit higher. So we've touched 60 basis points in the 2-10 spread, and I think that is something to pay attention to. It doesn't surprise me that the shorter maturities are looking at this in a more dovish way than the long end, because the long end has not only to try to distinguish between what's going on with the economy and the Fed, but it also has to keep an eye on things like debt issuance and just total debt around the globe. We did postpone today's $22 billion 30-year bond auction because of the Fed meeting. We'll have that tomorrow. But I think it'll be very interesting to see how that demand goes. And then finally, Steve Leishman pointed to some of the percentages and probabilities in Fed fund futures. And I always put a word of caution that these things are just markets. They change moment to moment. But the next meeting that even is close to the possibility of an ease, anything over 50%, that would be the June 17th meeting at the moment. Back to you.
All right, Rick, we really appreciate it. And I think it's a good point to make that as this kind of settles in for the past 20 minutes, markets are looking a little bit more on the bond side like they were pre-decision, although equities are still near session highs. Let's talk more about that now with Jeff Kilberg. He's the founder and CEO of KKM Financial. What do you say, sir? Welcome.
Well, Kelly, kind of a surprise. Everyone was looking for a cut in rates, more hawkish. And we actually got more. If you think about that, $40 billion they're going to start purchasing in just a couple of days. That's annualized $500 billion of new QE. So with a $6.5 trillion balance sheet, I think a lot of folks were surprised. That was the initial reaction in equities, but you're seeing a little bit of a shift here, and we're waiting for the presser. But I think this was much more dovish, and I think Fed Chairman Powell is keeping his job for another month because that's the one that we haven't talked about yet. And I think the long end of the curve is not pricing the fact that he may not be here in May of 2026 if President Trump has his way.
So right when the decision came out, you were standing right there, and you
Yes.
heard me say, this is the son of QE,
Yes.
or QE light. Because to me, that's the headline. That's why stocks are moving. It's not the interest rate. No offense to any of our headlines or whatever. It's this diet QE
In the
with
immediate,
T-bills.
the sense of urgency. December 12th, they're starting to buy these bills. And that really kind of brings up the
Why?
question.
I
why?
thought the economy was booming. Everything was great. Kelly's got a solid gold yacht. Everything's fine.
Yes, but they are clearly seeing something now. Historically speaking, the Fed doesn't have the best track record. They talked about inflation being transitory, but nonetheless, they are seeing something. And this $500 billion annualized, it's $40 billion a month, folks. But this $40 billion a month that's starting in a couple of days, that is really surprising. I think that's going to move equities a lot higher because this is, I know we had one dissenter wanted 50 basis points. This is like a 35 basis point cut because it's another tool in their toolbox that is getting the same outcome. And it's going to increase the balance sheet, which is crazy that they just slowed the balance sheet down from draining, and now they're kicking it off.
There's a lot to ponder, and I'm totally sympathetic to that. I think you're right about the market taking it that way, no question. But, they'll argue that this is, it's wonky. It's financial system plumbing. It's that the bank reserves level is getting too low because we're in an ample reserves, not a scarce reserves regime. And we saw this in 2019 with the repo flare, but they don't want it to happen again. So it's more of like a management tool, right, of the financial system than it is a tool of monetary policy. Now, maybe those are two sides of the same coin, but it seems as though the real question is whether they intend to do anything beyond kind of keeping up with the level of GDP that they're kind of doing now with the balance sheet, doing something more meaningful, more expansionary, and I think there's going to be a lot more questions about that. What is their intent now with the balance sheet? Is this just a temporary fix to a repo problem, or is it something more?
It feels like they brought the first aid kit out, and we haven't seen the wound yet. So maybe this job situation is going to decrease or get worse. But right now, the economy is strong. We're seeing profits. We just saw Q3 profits, Kelly. It doubled expectations. Yeah. And I know there's been an old saying, profits are the mother milk of the stock market and the economy. Maybe we update that and say, profits are the creatine of the stock market and economy. But we are seeing such strength. This is very surprising.
Can I say something that's probably a little bit controversial?
Please do.
Okay, which is, you mentioned Jerome Powell. He's a human being, okay? His term is up in May. No matter, I would think, and I don't know Jerome Powell at all, okay? Steve Leisman does, so maybe he can comment on this if he pops back on, but I know he's got to go to the lockup. Jerome Powell's a human being. He wants to go out looking good, I assume, right? Does that factor into the thinking? You don't want to go out doing something that causes the stock market to go down or wobbles or whatever it might be. I think you want to go out, particularly when you're being attacked by the president every week. You want to go out kind of on top. And I don't think it's unfair. I know it's the Fed, but these are human beings whose heart pump blood. I think there's probably a feeling they want to feel good and go out like a hero, not a villain. Yes or no?
Not necessarily. Fed Chairman Powell, I think he's done a great job of deflecting all that. He's a strong human. He's always been fiduciary. He's doing what he thinks is right. So I don't think he's going to bend one way or the other to make his, riding off into the sunset look better. But he's doing this for a reason. And that's where I really want to unpack and get a better understanding. Why did they do more than the 25 basis point expectation? Because in essence, they did.
All right.
Maybe they did. Maybe it's just a tool for, the banks have been having a hard time. Jeff, I don't know if you saw all-time highs, for the bank stocks.
I note sarcasm.
But Kelly, think about it. Every time they've cut rates with the S&P near a 2% or less high, when we're just close to an all-time high, the times they've cut it, it's been 20 times. Guess how many times a year later the market's been higher? 20 times, 100%.
And that's why we talked to Tom Lee, or a little bit earlier on, who said he said even if it's a hawkish cut, he would view that as kind of a bullish outcome or a bullish signal. So you have to imagine that this leaning more in the direction towards accommodation
seems dovish.
Even more so. Yeah. Do you do anything else now to change your thoughts prior coming into this meeting or no?
No, I think you have to really focus on this presser. We're going to see what's about to happen.
Yeah.
We're going to take a short, speaking of, let's take a very short break, folks. One small commercial break, come back, it's the final comments. Then all these questions we've just asked, maybe they get answered by those three flags. We're back right after this. All right, welcome back to Power Lunch. Again, minutes away. You referenced, Kelly, the XLK Tech ETF. Why?
There's a couple of reasons. I mean, we also need to look at tick by tick what's been happening since the decision at 2, which was initially we saw this big positive reaction. As Brian mentioned, it pushes the tech ETF, the XLK, now to possibly a 13 consecutive day of gains and a winning streak. However, look at what's happening on the screen now. We're already seeing this pre-Powell positioning where those gains that we had are coming out of the market. So the tech XLK is down about 0.25%. The small caps we'll have to check out as well. Those surged to an all-time high. Silver was part of that trade. The Dow is up as much as a little more than 300 points. A few moments ago, Kilburg gets up 206. So you see the potential for this market to take this and run with it in a dovish direction, but it's going to be really important how Powell emphasizes whether the QE that they're doing is simply bill purchases to help maintain the plumbing of the system or something more meaningful, along with everything else he's about to comment on.
I don't think he's going to give us a look underneath the hood to that extent, but you're absolutely right. That's what the market's going to decipher by the end of the week, and that's why I think the longer, bigger picture here is that Treasury yields, we got more than we actually bargained for today with that 25 base rate cut.
So to your point about 20 times out of 20 times, by my math, and I went to an engineering college,
it's pretty good.
That's 100%.
It is.
That stocks are going higher over the next year on this cut.
It's not going to be a straight line, Sully. It never is. But when you see the VIX in conjunction with that stat, when you see the VIX, the decay in the VIX, just remember 2 weeks ago when we were a little bit squishy about the actual Fed interest rate cut happening or not, we saw the VIX go up to 28, went back down to 15. When you see that vol get crushed like that, that's when you see people really feel good about equities on a 30-day lookout. And then, yes, that stat, Sully, 20 out of 20 times higher a year later.
What are you listening for as he kicks this off, Kilburg? What
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5% to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend, so it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions. And we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both showed declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves that's, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, it takes, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Mike.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most.
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But, it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing the most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people, they also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what?
On the committee?
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about
how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris. Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about the bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman, Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's not it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Sooner than we thought as well. The chair says to manage reserves, you can call it QE light, call it whatever you want. Stocks jumping on that news. You take a look at the Dow, up more than 1% right now. In fact, the S&P may, in fact, set a new closing high today. We had 3 dissents for the first time since 2019. It does point to the divided Fed that we've all been talking about. Welcome to Closing Bell. I'm Scott Wapner. We're at Post 9. Let's continue the conversation now with our Fed Day tradition. Double lines. Jeffrey Gunlock is with us exclusively. It's good to see you. This may sound so strange to ask it like this, but did we just have a hawkish cut inside of a dovish meeting? Did we just get that?
I don't feel like that was a hawkish cut. I thought that it was interesting that he used the word well-positioned. You opened your remark with that. Well-positioned is the phrase of this meeting. And he went on to basically repeat well-positioned when he was asked, are you really on hold now? And one of the most interesting things was he emphasized this idea that's new to me anyway, that he thinks that the monthly jobs gains are 60,000 overstated. And so he says maybe a 40,000 stated job report is really a negative 20. And that sounded pretty dovish to me. And as he went on in the press conference, he seemed to de-emphasize inflationary risks. He's gone back to talking about break-evens from the tips versus nominal Treasury market, which is appropriate. He's right about that. That's been extremely well contained in the mid-twos for quite some time. So he says he's well positioned, but he really emphasized things like, well, maybe, inflation will tick up because of jobs, being in demand or something, but I don't expect that to happen. He went out of his way to frame inflation as less of a problem. He even went so far as to say they're making good progress on inflation if it weren't for those darn tariffs, So he's trying to carve out some real estate for himself on these things. But when he says he's well positioned, I really agree with him, because at long last, the Fed funds rate is the same as the 2-year Treasury yield. It's fascinating that the Fed has dropped rates 175 basis points beginning a year ago, September, but the 2-year Treasury rate is completely unchanged. So a 175 basis point drop in Fed funds has finally gotten it back down in line with the 2-year. So I think he is well positioned, and he seems pretty clearly focused more on the employment risk of unemployment rising than he is on inflation being a problem. So I think this was sold, was kind of sold to be expected to be a hawkish cut, but I don't think it was. And when you ladle on top of the cut and the language surrounding it with the $40 billion of what some people will call QE, I mean, that's kind of interesting. We've been doing QT for a long time, and all of a sudden, out of the blue, we've ramped up QE, which is probably giving people some hope that there's going to be QE if needed, and I suspect that is going to be the case. One thing that's fascinating is that people keep talking about the Fed cutting rates to help housing. Well, the Fed cutting rates 175 basis points has not helped housing. What's happened is that long-term interest rates have risen as the Fed has cut rates 175 basis points. The long bond, the 30-year Treasury, is up about 75 basis points since before they started cutting rates, and the 10-year Treasury rate is up as well. So I continue to believe, and this has been my thesis since they started cutting rates, and the market action seems to have corroborated my view, that the Fed cutting interest rates is not going to be helpful for long-term interest rates. So today we had the Fed cut, and the curve steepened again. We're out to 230s, out to about 123, 124 basis points. The high this year was 130. So I'm thinking that we might see long-term interest rates actually rise on this more dovish Fed. But I think that this is not a hawkish cut, Scott, in my view.
I mean, I asked it the way I did because you could say, well, Powell says the bar is high for more cuts. As you said, they're well positioned to wait. Those are his words. You say, OK, that's the hawkish cut that we were expecting. But then when they lay on the announcement of the Treasury purchases, the market is at the highs of the day. The S&P could do a new closing high today. You'll say, well, maybe that was actually a dovish meeting because of what some already consider this to be QE light. You get where I'm coming from?
Yeah, I do understand that. The thing that's interesting about this meeting is the dissents. You know, you had the Myron guy wants 50 basis points all the time. Two didn't want any cut. And I guess there were a few what they call soft dissents as well. So the committee seems more hawkish to me than Jay Powell's press conference. So I guess in that sense, you could call it a little bit of a hawkish meeting. But from the statement and certainly the press conference, I thought it was more dovish than most people expected. And so when he was asked about, is it possible that we could have rates go one way or the other, you know, you might even hike rates, not just cut rates, Powell's answer was pretty much there's no way we're hiking rates, is what I heard for the answer to that rather specific question.
Well, he said it wasn't the base case, right? He said hiking rates wasn't in any way the base case at this point, almost as if they're not even thinking about it at this point.
Well, that's right. Yeah, he's basically, one way to interpret that is we need the data to radically change for us to think about hiking interest rates. And my guess is that they're not going to cut rates. I don't think they're going to cut rates. I think he's going to go out with the Fed funds rate. If the 2-year Treasury stays where it is, he'll probably end his term with the Fed funds rate where it is right now. But if they're going to do one thing rather than the other, it would be cutting interest rates. And we'll have to see what that data comes out. He obviously emphasized multiple times that there's a boatload of data that's coming out between now and the next meeting. But we'll see how that goes. But
I'm confused, though, for a minute, though. If you just said that you don't think that he's going to cut rates again, but also noting that the chair said that they think that the job gains were overstated, that maybe the labor market is weakening still, and you still don't think that they're going to cut interest rates anymore. I get that the outlook is for only 1 in 26 and only 1 in 27. He'll be long gone, of course, as the chair by that point in time. But you're making a statement here that they're done?
Scott, I've said this so many times. I'm sure the listeners are tired of me saying this. The Fed follows the 2-year Treasury. They've been out of sync with the 2-year Treasury all the way through this cutting cycle, and now they've actually caught up. And so if the interest rate structure stays stable, and it's been so stable, the 2-year Treasury has been so stable for the past 2.5 years. In fact, most bond yields have been very stable. It was interesting during the press conference, people brought up the mid-90s, because I've been talking about that with my team, that the bond market this year reminds me of the bond market in 1995, where yields were about where they are right now, and they made a push towards 5%, but they never really could break out of a range. And we've been in a range for the past 2.5 years on Treasury interest rates, and that low volatility has allowed for significant stability as well and tight spreads in non-Treasury products, like the investment-grade corporate market, which had a spread, the all-time low spread of this cycle was 71 basis points, and I think we're at about 75 or 77 basis points now. We have junk bond spreads, which had a tantrum, the tariff tantrum, back with the stock market in March, April, but that's all the way back down to about 270 basis points or so. And so they're wider by about 15 basis points off their lows, but they're very, very stable. And one of the reasons that I think credit is very stable is the market for private credit has been absorbing an awful lot of supply. So in the old days, you had the below investment grade debt market was basically bank loans and junk bonds, the high yield bond market. But now it's three pieces. It's about one-third, bank loans, high yield, and now private credit, which has boomed in the last 5 years in terms of assets under management. And my view, and there's a lot of anecdotal evidence to support this, is that a lot of the junkier stuff has gone into the unregulated market. That means that the bank loan market and the high yield public market are actually safer now than they would have been at the same spread level, say 6, 8, or 10 years ago. And that's one of the reasons why the credit market has been so stable, and the bond returns broadly have just been quite good this year. The investment grade bond market is, over the past 49 years, this ranks number 16 in terms of total return, with many very low risk types of bond investments returning about 8%. You put that together with the stock market, it's been a wonderful year for financial assets broadly. And if you followed my advice for this year, I've been actively interested in gold. I turned neutral on it a couple months ago, but positive on it again last week. So gold has done well. U.S. markets have done well, but foreign markets have done even better. And right. I've been a fan of local currency emerging market debt. That's the best performing sector for dollar-based investors, and also foreign stock markets have outperformed the U.S. So this has just been a phenomenal year for dollar-based investors that have been diversifying. First of all, their dollar-based investments are doing just fine, but their non-dollar-based investments are having a further profit on the currency translation in addition to superior index returns. So this has been, again, it's a lot like 1995, a year where you worry a lot during the year, but when it's all said and done, it's turned out to be a pretty positive experience, no matter how you look at it.
Yes, I mean, certainly our viewers know that full well if you look across a number of different asset classes. Jeffrey, bear with me for a moment. Steve Leisman's made his way out of the room, our senior economics correspondent. So what is your biggest takeaway? And by the way, I'm not sure if you heard Jeffrey say before you got in front of the camera here that this may be Powell's last cut, that he may be done.
Yeah, we've been talking about that today, Scott, that this could be it, and I'll show you how that could be the case in just a second. I do want to point out that my concern had been being replaced by AI as a reporter. I'm now a little worried about being replaced by Gunlack, and the reason, Scott, is because I came out thinking that the operative phrase of this press conference was well positioned, and I heard Jeffrey say exactly that. And just in case you haven't heard it yet, here's another. Here's one of the 6 times actually that I found Fed Chair Powell used the term well positioned, and I'll talk what I think that means on the other side of this.
We now cut a total of 175 basis points, and as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
So my question to him, Scott, as you might recall, was the extent to which the Fed is well positioned or has already taken out risk insurance for potential additional downside weakness to the jobs market. And I think what he's saying is, yes, we have. Obviously within tolerance if the unemployment rate skyrockets up, but they're already factoring in some revisions to the payroll numbers. So I think what you see is what you get for a bit when it comes to the funds rate. And again, if you look at the probabilities and why this could be Powell's last rate cut, you'll see that there's a 60% probability they go again in April. That's not tremendous conviction there on the part of the market. More conviction happens when? In June, after the new Fed chair comes in. And just one point of disagreement, Scott, with Jeff. I'm not sure I would call this QE. What's happening is mostly going to be largely on the short end of the curve, mostly going to be bills. I don't know if they'll come back in and sterilize that on the back end after they get through April. But ostensibly, this is to replace or to keep the balance sheet at a given or a fixed ratio relative to GDP and the economy. So, and also to smooth over certain times where there's tremendous demand for reserves. I know the Fed would not characterize it as QE. I guess everybody has a right to call it what they will.
Well, yeah, I mean, look, he went out of his way, I feel like, as well, the Fed chair, saying multiple times, quote, for the sole purpose of managing their reserves. I think because one would understandably say, well, if it's maybe not be full-blown QE, it could be baby QE, it could be QE light. The fact of the matter is, Steve, the market is taking that news, which is going to happen sooner than we thought, as bullish, right? If you just had the Fed chair come out and say the bar is high for more cuts, and we took that as a hawkish cut, I'm not sure that the Dow's up 600 or that the S&P 500 is on the verge of a closing high.
I guess I wonder the extent to which this really does actually, over a longer term, juice stock market returns. Maybe it does. But I will say, Scott, there are those people who are more traditionalists when it comes to the Fed's balance sheet that are rolling their eyes. In fact, there are people who are well in the back of their heads right now that the Fed is managing the balance sheet by doing it this way. There are other ways out there, and people want to see the Fed. People like Kevin Warsh, maybe some of the people coming in to be the next Fed chair, want to see the Fed reduce the size of the balance sheet. It's a separate discussion, but the idea that it has to do that to essentially manage reserves through difficult periods is part of the problem, these people would say.
Gotcha. Steve, thank you, as always.
Sure.
Steve Leisman, back outside the room and spending time with us. We appreciate you down in Washington. So, Jeffrey, you so rightly told me last time that you were looking for a steeper yield curve. And it's exactly what we've gotten, as you alluded to that. Why do you think rates have backed up on the long end the way that they have?
People are worried about the interest expense on the Treasury debt, and they're worried about the fact that the budget deficit is 6.2% of GDP while we're in an extended economic expansion. So they're worried that the interest expense is going to be out of control because it's risen by nearly $1 trillion over the past decade in terms of how much money the interest expense is. So I think that that's really the problem. And it's interesting that the Treasury issuance of the last 12 months, only 1.7% of the Treasury issuance over the past 12 months is 20 years or longer. It's this trivial fraction of the debt issuance. 84% of the debt issuance over the last 12 months is T-bills. So the T-bill market is massive compared to the rest of the total fixed income market in the United States. I'm talking about all sectors combined. T-bills are something like 2/3 of all of the securities that are out there. So it's interesting that long-term interest rates still are rising as the Fed is cutting rates when such a small fraction of the issuance is long-term Treasury bonds. So I just think that the rise in long-term interest rates is not just a U.S. phenomenon. It's happened in all developed countries. We've had the same rise in the U.K. as in the U.S., over this rate rise period from 2022. And we've had Japan and Germany go up, not quite as much, but they've gone up a few hundred basis points as well. So I believe that's just a global phenomena in the developed world, certainly, that people don't trust the way these finances are being handled. Mm-hmm. And for that reason, gold has had this ridiculous return. Gold is up this huge amount this year, and silver is up even more, which is actually not a great sign. When silver joins the speculative frenzy of precious metals and it starts to really outperform, I mean, silver's up over 100% this year, usually that, I'm afraid to say, starts to foretell some sort of a problem. Some sort of a financial problem. It doesn't mean it's coming anytime in the very near future, but it's a bad sign when silver goes to join a wild speculative frenzy. So I still think that gold has a place in a portfolio, but I also think commodities broadly have quietly started to rally. if you look at the Bloomberg Commodity Index, it's been rising, and now even its 200-day moving average is rising. And of course, the actual value today is above its 200-day moving average. So for the first time in a long time, I turned positive on commodities broadly last week. So I think a commodity index makes some sense in here. The one thing that's not inflating seems to be crude oil, which is very positive for the inflation side of the dual mandate of Powell. And I think one of the reasons that he's downplaying that side of the dual mandate is because the price of oil has been gradually declining for quite some time now, and it seems to be forecast by the shape of the oil futures curve to be in the high 50s for the next 12 months. That doesn't mean it's going to happen, but it's very rare that you have the oil futures curve predict no change in oil one way or another over the ensuing 12-month period. So I think that the portfolio framework that I've been talking about, gold and now maybe some broader commodities, foreign investments, non-U.S., non-dollar, local currency emerging markets, and that part of the yield curve that's the real performer, which is the belly that I've been talking about, the 2-year, the 3-year, the 5-year, the 7-year Treasury, that if you owned the 2-year Treasury leveraged 10 times, you've blown away the performance of any other spot on in the Treasury bond market. I don't think that's going to change. I think the yield curve is going to keep getting steeper, and we'll probably end up with 230s going at least to 150 basis points from about 120, 125 where it's settled in for the last few months.
Let's turn our attention to the next Fed chair. We know that Chair Powell's term is up in May. Interviews are starting today with Kevin Warsh. If President Trump called you up and said, Jeffrey, of my final 5, who should I put in that chair? What would you say?
I'd say put the 2-year Treasury in charge of the Fed funds rate, because that's what's always going to happen anyway. It's been happening for decades. But I don't know. I don't have any particular insight on who's going. I just know that who's going to be chosen is going to be a dove, because that's the only type of a profile that President Trump is going to opt for. We just know that. It actually came out yesterday in the news. You know, I've been saying there's going to be one question in the job interview. Will you lower interest rates if I tell you to? Well, yesterday, Trump almost said that it's going to be a litmus test. There'll be a litmus test for the next Fed chair. Are they going to lower interest rates aggressively? So that's what's going to happen. That's why the Fed funds market, you know, they don't expect much of a change in rates. But then in June, all of a sudden, the probabilities go way up because everyone believes, rightfully so, that the president is going to pick somebody who's going to be a dove. And that's going to be a yield curve steepener as well. And it's going to be negative for the dollar. So you should be increasing investments in non-dollar assets, particularly in the emerging market fixed income area, which has been a great performer. But I think this is early innings for the outperformance of non-dollar investments relative to dollar investments.
Jeffrey, stay with me another second. I'm going to go down to Washington. We do have breaking news. The president is reacting to this rate cut. Eamon Javers joins us now. Eamon, what do we know?
Scott, that's right. Take a live look now at the Roosevelt Room over at the White House. The president is meeting with CEOs from the Technology CEO Council, including Michael Dell and other high-tech executives. He just gave his first reaction to the Fed rate cut in that meeting. He said it was too small. He said this rate cut could have at least been doubled. He was not impressed. He called the Federal Reserve Chair a stiff and said that the Fed is too focused on inflation and therefore they are killing growth by not lowering rates even more. So the first reaction there from the president in real time. I also want to flag for you, Scott, a comment that the president made. He confirmed that the U.S. government has seized an oil tanker on the coast of Venezuela. He called it a large tanker, very large, largest one ever seized. So we have confirmation of that news now from the president of the United States. He also said other things are happening. So you'll be seeing that later, and you'll be talking about that later with some other people. So we don't know exactly what the president was referring to when he talked about other things happening, potentially in the context of Venezuela, given how he expressed it. But he did confirm that the United States has seized an oil tanker. We expect to learn more about what tanker it was, on what basis it was seized, and what that means for U.S.-Venezuelan relations as well. Scott, back over to you.
Eamon, thank you. Eamon Javers. We'll go back to Jeffrey Gundlach. I'd like to get your reaction to that because it's quite clear we have another dissent of sorts, Jeffrey, at 1600 Pennsylvania Avenue, who says at least doubled the latest cut, i.e. wanted 50.
Yeah, well, what else is new? I mean, Powell took a little jab at Trump by blaming what inflation progress has failed to materialize is because of the tariffs. I think he said it 2 or 3 times. So if you jab Trump, he's going to jab you back and call you a stiff and everything else because that's just the way he's wired. So not surprising that Trump wants a bigger rate cut, and that just means that we're going to get more rate cuts. That just doubly reinforces what I've been talking about. We're going to get rate cuts after Powell's gone, and it's going to weaken the dollar. I just think this is crystal clear. It's already been materializing. The dollar's already down. It's one of the worst years for the dollar in the last 25 years, and I think that the rate cuts are going to weaken the dollar further. And investors should think about that seriously because it's already happening in real time. This year has been absolutely following that playbook, and Trump is telling you through that outburst that rates are coming down in the second half of this year. And I don't think he even cares what the inflation rate is, Trump. He just wants nominal GDP to go up, and he just wants positive numbers all over the place. He doesn't care if it's inflationary. I care a lot as a bond investor. That's why I'm avoiding the long end of the bond market and playing it safe in higher quality securities, just in case things get out of control and there has to be some sort of emergency stuff done later on. So the QE thing, Steve Leisman, I can't replace Steve Leisman. He knows that. But I did not say that it was QE. I said some people would say that this $40 billion a month for 5 months, $200 billion altogether is QE. But it is. He did emphasize that it's just liquidity management and all that. But the people that want to call this QE, I will give them one tip of the hat, and that is the journey of 1,000 miles begins with a single step, the old Chinese proverb. And when you're doing this now with T-bills on an accelerated basis, it means that you are more open philosophically to doing quantitative easing than you were certainly when you're doing quantitative tightening to the tune of tens of billions of dollars per month. So it looks like they're focusing more on the employment situation, less on the inflation situation. This is not a positive for long-term interest rates in the developed markets and certainly in the United States.
All right. So we know, since we're just talking about President Trump, that among other things, he also wants the stock market to go up. You declared last month this to be, quote, one of the least healthy stock markets of your career. How so?
Well, it's because the valuation is so high, and it's kind of a mania-like in terms of the leaders being, very aspirational. This is reminiscent of prior manias. It's reminiscent of the dot-coms. It's reminiscent of the financing in the housing market. But one thing about unhealthy markets, one thing about markets broadly, whatever you think is going to happen, it's going to take a lot longer than you think. The one thing I've learned at almost 45 years in this business is you might be exactly right on the direction, but it always takes longer than you think. I always bring up the anecdote. I turned maximum negative on the NASDAQ September 30th of 1999. In the fourth quarter of 1999, it went up like 85%. I looked like a total moron because of saying that I was maximum negative at September 30th. But just 18 months after September 30th of 1999, if you had gone short September 30th of 1999, you had a gain of 64% on just one turn short over 18 months. So it'll always take longer than you think. I've been negative on the dollar for a long time. It took longer than I think. It will always take longer than anybody thinks. That's just the nature of the beast. It works in a cycle that isn't days, weeks, or months, and sometimes not even years. So it can stay unhealthy for a long time. But the valuation of the market relative to GDP is very, very high. and it's very high on a book value versus other markets. And I think that it's somewhat warranted by a lot of the policies, the very unusual policies that have been put in place for the past really 15 to 18 years or so. But I'd be careful. I'd be careful that, because once it breaks, you're going to lose money very quickly. So this is one of the reasons why I have been substantially underweight the U.S. market, and not regrettably, because the other markets have done better than the U.S. this year. And I think this is not the end of that trend. It may even accelerate as we go into 2026.
Well, there was a lot of catching up for a lot of those other markets to do, too. And we shall see what 2026 holds. Jeffrey, you talked about your 45 years, that experience we lean on every Fed meeting for what has become a great tradition for us. I wish you the best, happy, healthy, and I look for you in January. See what happens.
Absolutely. Good luck, everybody out there, and go Bills.
All right. We'll see what happens there, too. Jeffrey Gunlock, be well. We'll see you soon. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Leslie Picker is tracking the action in the banks, and Seema Modi has the setup to a very important earnings report. It is Oracle out in overtime. Michael, I'll begin with you. Your take on this market reaction to what happened today.
Yeah, this is a market that was at least wary in advance of what it thought was going to be a hawkish rate cut, and it just really wasn't that hawkish. I mean, I agree with Jeff on that. In the commentary, mostly, I don't even think it's about the $40 billion a month in buying T-bills because that was out of 2 o'clock. Okay, this market actually started to levitate over the course of the press conference, and when people digested the kind of committee outlook, which is expect more growth than we thought in September for 2026, expect unemployment not to really go up, and we're still going to price in a cut. We still have an easing bias. In other words, they're not going to stand in the way of the economy gathering pace. The reaction is almost pristine in terms of what you would want to see if the market were gaining confidence in the cyclical outlook. It's value over growth, it's small over large, it's equal weight ripping relative to market cap weight, it's volatility getting crushed. So everything that the market was kind of getting in the direction of gearing up for, which is we're going to have a quicker economy, and sure, the Fed can be on hold, but that's not going to stand in the way. I think that's all positive. So this can change. We can have some kind of a shock out there and a rethink in the morning. But for now, I do think that even though they may be on hold, they're not doctrinaire about it. How many times did Powell speak glowingly about the productivity growth of the past 2 years? He's signaling that they don't really want to restrain the economy in any material way.
Hey, how crazy would it be in the year of AI and the Mag 7 and all that the Russell 2000, okay, which today is up almost 2%, is now up 15.3% year to date and may very well make a run to be the second best performing index of the year before it's all said and done. I don't know how many people saw that coming, but that is the case as we sit here today. It's up near 5% in a month.
Yes, it's a catch-up move, obviously. The year-to-date frame definitely flatters the Russell because we're really not up that much from 4 years ago.
Right.
But it does show you that this is the way the market is migrating. And that just says not just cyclical gearing in the market, but also risk appetite's rising. Okay, that's also going on. The high beta stocks are flying. So it's not just, kind of picks and shovels, old industrial stuff working. It's we think we can let it rip a little bit. So we'll see, again, if that overshoots or at all. But right now, it does seem as if you would say that that's a positive risk-seeking signal.
Yeah, there's green, a lot of green on the board, obviously, including the banks. I got JP Morgan up 3%, a nice move back from those losses of yesterday. Leslie Picker is following that, has really spent the last couple of days in the center of the conversation, Leslie, about the banks.
Yeah, banks certainly bouncing today, as you mentioned, Scott, thanks to a lot of optimism from executives speaking here at the Goldman Sachs Financial Services Conference. Overall, Wall Street firms expect continued growth in investment banking and trading revenue. Consumer spending, they say, is resilient. We heard that word from several executives. And credit quality seen as stable. However, some executives noted the health of the consumer depends on the labor market, which Blackstone President John Gray said was weakening.
The labor market has softened a bit. So when we talk to our CEOs, they say it's much easier to hire today than it was 3 years ago. And wage rates have gone from sort of low 4s to call it 3% on an hourly basis in the U.S. And I think that softening of the labor market, given the Fed's dual mandate, will help them cut rates.
We'll hear more about the labor market and rate cuts in the 2026 outlook from Bank of America CEO next hour. Scott.
Wow. All right. Good stuff. Continued. Leslie, thank you so much. That's Leslie Bicker. I said we're waiting on a really important earnings report in overtime. It is Oracle, and Seema Modi continues to follow that story for us. Hi, Seema.
Scott, it was about 3 months ago in September when Oracle revealed that massive bookings or remaining performance obligations number of $455 billion that sent the stock up 36% in one day. Since then, the stock has erased those gains. So tonight, can Oracle repeat history? Analysts are expecting yet another big RPO number of over $500 billion. But as you and I have discussed, the street also wants details on the speed at which it will continue to go to the debt market to fund its commitments to OpenAI and other customers. This is the first earnings call with Oracle's 2 new CEOs. But as always, commentary from founder Larry Ellison, that will be top of mind. He's widely seen as the person who is the driving force behind the company's pivot into AI cloud computing. Now, worth noting, the stock has rebounded in the last week of 10%. Credit default swaps giving back as well, Scott.
All right, Seema, it's going to be exciting. We'll see what happens. Michael, I'll turn back to you. The importance of this one is what?
It's pretty significant. I mean, we haven't, for all the good things that the market is embracing right now about the macro and how maybe the cyclical parts of the market can work, we haven't called off this really pitched debate about whether we can and should finance the AI infrastructure boom the way we are right now. It's remarkable how Oracle has become the concentrated, touch point for all of these arguments, pro and con. So it is quite fascinating. I think the overall credit markets have done fine, right? They have not really been unsettled by even some of the ripples in data center-backed debt. So I think that's a positive. It's much more about how fast can we go, how much confidence do we have about, the demand continuing there. And if OpenAI's got $1.4 trillion in commitments it's already signed up for, how much capital is it going to consume at what ultimate cost? Meanwhile, the world wants to talk about data centers in space now, right? So it's kind of like, it just seems way too open-ended with a wide range of potential outcomes to gain too much comfort in the short term.
Mike, we've been talking a lot about a so-called everything rally, whether we would actually be able to get one between now and the end of the year. There were some signs, then some not. Now I wonder that we get the Fed out of the way. We didn't get to your thinking anywhere close to the hawkish cut that the market was clenched up for. Does this now clear the path for that?
It's hard to see an identifiable obstacle to the market having that kind of a lift. Now, it doesn't mean it's going to be, again, the broadest and the most aggressive and highest momentum, because the market hasn't really indicated that it wants to really hightail it to the upside in a broad way. But, today could be the start of something like that, and at least you have to give credit to what the tendencies are, which is, strong years tend to finish strong, all the things we know. I know everyone wants to talk about how when the Fed cuts rates and the market's within 2% of an all-time high, it's always been higher a year later. That's very true. But it was 2.17% off an all-time high in October of 2007. So if you widen out the scales, sometimes it doesn't seem as much like a sure thing. But right now, I think the market's giving you the message you probably wanted to pull after this Fed decision.
All right, good stuff as always, Mike. Thanks for adding your own insight into this big market day today. So the Dow's going to go out around 500. The S&P is going to fight it out to the finish to see if it can get a new closing high. Doesn't look likely, but you never know. I'll see you on the other side.
That bell marks the end of regulation. Greek American Issuer Day went in the closing bell at the New York Stock Exchange. The National Kidney Foundation doing the honors at the NASDAQ, and stocks shooting higher after the Fed cuts rates a quarter point. The Dow's up more than 500 points. The S&P 500 very close to an all-time closing high. The NASDAQ with a gain of less than 0.5%. The best performer today, the Russell 2000. The small caps hit another record high. Industrials and materials, the basics, are the top sectors today. Gains also in discretionary and healthcare. The yield on the 10-year note pulling back to 4.14 after this rate cut. Gold and silver higher again, another record for silver. Gains for crypto, Bitcoin back above 94,000, and oil closing at the highs of the day after the president confirmed that a tanker has been seized on the coast of Venezuela.
That's right. Keep an eye on geopolitics, but that is the scorecard on Wall Street. Welcome to Closing Bell Overtime. I'm Morgan Brennan, along with John Fort. A couple big names reporting results this hour. Remember the fireworks after Oracle's last report? We're going to see what happens this time. We have Adobe also set to report earnings.
And Synopsys also due out with results. The company's caught in the middle of U.S. restrictions on chip exports to China. We're going to talk to the CEO before the analyst call.
And Bank of America's Brian Moynihan is set to join us. We're going to get his take on the Fed, on the economy, and so much more.
But first, let's get to Christina Partsinevelos right here for the stock market reaction to the Fed decision.
Well, the Fed cut took center stage along with plans to start buying Treasury bills. Again, the less hawkish tone really helped lift, like you mentioned, the Russell 2000 to a fresh all-time high. Small caps tend to do well when rates come down since these companies lean heavily on borrowing to grow. Regional banks, looking at the KRE, were up big too, closing almost 3.5% higher. The larger names like Truist, M&T, Huntington, Citizens really leading the charge, and that's because lower rates ease the pressure on their funding costs and could help stabilize those deposit outflows. Wall Street's big banks also joined the party of Morgan Stanley and Goldman Sachs, closing at an all-time high today. Over in individual movers, GE Vernova was the S&P 500's top performer after updating its financials at yesterday's investor meeting. An upgrade to outperform from Oppenheimer didn't hurt either. And then on the flip side, Uber was one of the day's worst performers on the S&P 500. And lastly, Warby Parker kept climbing today on that Google AI partnership announced just over the last week. They're working together on AI-powered glasses that are set to launch in 2026. Citizens also upgraded the stock today to overweight. Shares closed 27% higher.
AI-enabled hardware seems like it's going to be a big trend looking at 2026. We'll see. Christina Partsinevelos, thank you. Now let's get to the bond market and to the moves that we saw on the Fed today. Rick Santelli is in Chicago with more. Hi, Rick.
Hi, Morgan. Indeed, it was an exciting day in the Treasury complex. If you look at a two-day of 2-year and 10-year, what you'll notice is that after rising right before all the meeting information came out, early in the session, we hit a 4.20 yield in 10s. Then both maturities dropped, the entire curve dropped, and we had a bullish steepening, meaning we're down 9 basis points on that 2-year. We're down 5 basis points on the 10. Those 4 basis points represent steepening. As you look at the 12-hour 2s10 spread, you can see how it jumped up. It's hovering at 61. When was the last time we were up there? Go back to early September. So it's been a while, 3 months plus. Now, let's look at what's going on with the dollar. The dollar really got hit on today's news. As a matter of fact, where it currently sits now, should it close here, it will be the lowest close since the 20th of October. John, back to you.
Rick, thank you. Well, the Dow's up 1% after the Fed cut rates, and Fed Chair Powell saying the real division within the Fed now is whether to hold or cut versus any potential hike in the near future. Joining us now is Jefferies chief market strategist and CNBC contributor, David Zervos. David, the president wanted a half a point cut here. Is this quarter enough?
I think the quarter's, being rejoiced a little bit in the market just because the market was set up for this hawkish cut and they didn't get it. You got the QE announcement or the soft QE announcement. But more importantly, John, what you really got was a message about how this Fed sees stronger growth without a lot of inflationary pressures. That's what we see in the SEP. And that subtly really changes the ballgame for the potential of a Fed that would get hawkish. Because what gets a Fed hawkish? Strong growth, retail sales, everything's starting to kick in. But what the Fed's telling you is that growth is probably coming from productivity. It's coming from not a lot of job creation, actually a semi-weak labor market, and there's no need for them to fight that. In fact, they may need to be looking at cuts because there's too much job destruction as that productivity growth increases. So I thought it was a very dovish forecast.
Do you think that the market estimates are being too pessimistic then, if you're on that side of it, about no more cuts until Powell's gone? And are you still in the strongly risk on camp?
Still in the strongly risk on camp. Certainly excited about our risk parity trades in 2026. And I do think the market is probably on the mark for some slowing of the risk of cuts as Jay's last 3 meetings come into play for the beginning of the year, but recognizing that as this Fed composition changes, as we learn more about the Lisa Cook trial and other things, this Fed is turning dovish, and in 2026 will be a more more of a tailwind to risk assets than a headwind to risk assets. The beginning is a little risky, but I actually think we took a lot of that off the table today with their forecasts. This was a really, to me, a very dovish forecast, a strong growth dovish forecast, which is hard for people to process. But what they're saying is the inflation risks are really not going to be persistent. And he said that a couple times, Morgan, in the speech, that this was really tariff related and one-off related in all likelihood, inflation.
Yeah, and he kept talking about services inflation coming off as well. Stay right there, David, because we've got breaking news out of Washington. So let's get to Eamon Javers for that. Eamon.
Morgan, that's right. President Trump, as you take a live look, still speaking to reporters in the Roosevelt Room at the White House. He was having a meeting with CEOs, that event ongoing. The president's just been talking about the Fed, as you guys have been discussing the Fed. He confirmed that he has a meeting with Kevin Warsh. That's been sort of widely speculated about or reported. But the president also said, I sort of have a very good idea of what I'm looking for in terms of a Fed chair candidate. He says, I'm looking for somebody that will be honest with interest rates. He says, honestly, our rate should be much lower. He says he's not going to be asking the candidates to commit to lowering interest rates, but he says he's going to ask them questions and he'll know what he's seeing in terms of the answer there. So it's clear that the president is putting a low interest rate threshold here on his selection of Fed chair. He is meeting with Warsh, although Hassett has been reported to be in the lead for that job. The president's saying, I sort of have a very good idea of what I'm looking for. One other note here from this meeting, guys, on the Warner Brothers sale. The president was asked about CNN and what he thinks of the prospect of CNN being either included in that transaction or not included in that transaction. The president said he thinks that no matter what happens to Warner Brothers, that CNN should be sold either to the new buyer, that is Paramount or Netflix, or should be sold to have new ownership in charge of CNN. That's because the president says he doesn't like what he sees as CNN's political bias. He doesn't like the content that he sees on CNN. He wants them to change it. He wants new ownership there. And ultimately, the president's saying that he thinks CNN should be sold as part of this transaction. Now, how does that shake out in terms of Netflix not making an offer to buy CNN, Paramount making an offer to buy CNN? All that's going to have to sort out, guys.
Okay. Eamon Javers, thank you. We've got Oracle earnings out as well. Seema Modi has the numbers for us. Hi, Seema.
Hi, Morgan. Second quarter earnings from Oracle coming in better than expected at $2.26. That is a non-GAAP figure versus the $1.64 adjusted estimate. But revenue coming in slightly below expectations at $16.1 billion, likely due to a weakness in software revenue, which again just came in slightly light. If we look at AI and cloud, the remaining performance obligations, which is the key bookings number, up $523 billion in the second quarter, up 438%. That is a higher growth rate than the previous quarter and above street estimates. Cloud infrastructure seeing gains of 68% year over year, stock down about 5.6%. We have comments here from CTO and Chairman Larry Ellison, how the company is selling Ampere because we no longer, he says, think it is strategic for us to continue designing, manufacturing, and using our own chips in our cloud data centers. He adds that we are now committed to a policy of chip neutrality, where we work closely with all our CPU and GPU suppliers. Of course, we will continue to buy the latest GPUs from NVIDIA, but we need to be prepared and able to deploy whatever chips our customers want to buy. There are going to be a lot of changes, he says, in AI technology. I would perhaps look at shares of NVIDIA to see if they're responding, but some interesting comments here from Ellison. I don't see any specific comments on financing, which of course is a big topic of discussion around Oracle, the funding of its massive data center build out, but I imagine that will be a big topic when the earnings call starts at 5 p.m. Eastern. Analysts asking for more transparency on whether this company will continue to lean into the debt market or use other tools, Morgan and John, like vendor financing, equity, or bringing in a sovereign wealth investor. Again, shares of Oracle now down 6% in overtime.
Okay, Seema Modi, and we know you'll be watching and bringing us those headlines when that call does kick off. Appreciate it. David Zervas, I want to get back to you. There's a lot we just covered right there, but I actually want to bring this back to some of the reporting we just got from Eamon Javers. I mean, it's widely seen that Powell is a lame duck Fed chair at this point, but he still has 3 more meetings where decisions will be made. We did just get that SEP and the dot plot. How does all of this shape up, and how much of this hinges on who the president ultimately picks to be Fed chair? And I ask that as the U.S. continues to keep cutting here, or at least right now cut and be a little more dovish, but the rest of the world seems to be tilting a little more hawkish now.
Well, I don't know. I mean, the Japanese are obviously in a slightly different position, as they almost always are. But I wouldn't say the ECB, although there was some hawkishness in certain circles, I don't think that's something to get excited about. But I think everybody's kind of getting close to stable. As Jay said in the press conference, they're in the range of neutral, although at the higher range. And the debate now, Morgan, is really going to center on what neutral is. There's some folks who have shifted their neutral visions up dramatically, over 100 basis points since the pre-COVID level, all without actually changing their neutral growth rate assumptions, which have stayed the same at about 1.8 or 1.9. So we've had this huge shift in the neutral expectation. My personal belief is the folks that are coming in under President Trump, and there will be a number of them, I think, in next year, two and possibly a third, depending on what happens in the Lisa Cook trial. And of course, depending on whether Jay leaves, which I believe he will, I think you're going to have a view that neutral is lower. And that'll be the debate. The debate will be, how far are we from neutral? And there's going to be a push away from this raising of the neutral interest rate that has happened. And I think that's right. I certainly am at the bottom end of that range and would probably put myself as one of the lowest in neutral rate expectations. But we were at 2% pre-COVID in neutral rates, 2.5%. And I think that number is where we're going to ultimately settle after a lot of debating. But right now, we're still fighting that battle. So I think that's the dovish change that comes in 2026 and ultimately in 2027 as well.
Okay. David Zervos, thank you. With a Fed-induced rally here for the major averages and the dollar coming off and the lower end of the bond curve coming off as well, the yield curve coming off as well.
Meantime, Adobe earnings are out. The stock moving around a bit, slightly lower here, fractionally in overtime. The company reporting earnings of $5.50 a share, beat of 11 cents a share. Revenues of more than $6 billion, also topping estimates. First quarter guidance topping the estimate as well. Company says remaining performance obligations, a measure of backlog, stands at more than $22 billion. The CEO, Shantanu Narayan, crediting strong adoption of AI tools.
Well, shares of Oracle moving lower in overtime. That's the market reaction right now. We're going to get an analyst's take on the numbers we just heard, with shares down about 5%. That's coming up next on Overtime.
Welcome back to Overtime. Synopsys earnings are out. The stock is up around 6%. The company reporting EPS of $2.90 non-GAAP versus estimates of $2.78. Revenue coming in at $2.26 billion versus estimates of $2.25. Synopsys sees full year 2026 revenue of $9.61 billion. That's above the consensus of $9.58. The company is ending 2025 with an $11.4 billion backlog. Keep in mind they have the Ansys acquisition to factor in here as well. Coming up, the CEO of Synopsys is going to join us exclusively to break down the results before he dials into the call with analysts.
Well, let's get another check on Oracle meantime. After Q2 numbers that were out just moments ago, shares are under pressure, down about 4% right now, off the worst levels. Joining us now is Rishi Jaluria. He is RBC's software analyst. He has a sector perform rating, a 310 price target on Oracle. Rishi, your initial takeaway on what we got from this earnings report?
Yeah, absolutely. Thanks so much for having me. Always a pleasure to be here. Look, I think it was a pretty inline quarter. They obviously telegraphed a lot at the analyst day, which wasn't that long ago, although it feels in AI lifetime, ages ago. But the RPO was very much in line with what they had kind of pre-announced. Numbers were relatively in line, slightly missed on the top line. But overall, I would say, in line with what people expected, but we don't have answers to the big question, which is how are we going to pay for all of this build out? How are we going to pay to meet those RPO demands? What's the certainty around this? And I think this is going to be a very eventful earnings call in about 40 minutes as we get more color into those questions. What does a timeline look like? Anything like that? I think that's why I have the stock down a few points. But realistically, I mean, the implied volatility heading into the quarter is a lot more than that. And maybe the earnings call will change that.
I mean, that focus on potential financing alternatives and what paying for all of this looks like. I mean, is that ultimately what's driving the stock, at least here in the near term?
I think that's exactly right. I mean, all the enthusiasm around the large deals, including with OpenAI and everything like that, that's all there, right? And that's all embedded in the stock. Now the question is, okay, well, how do they get this out there? What can they do beyond debt? Are they willing to lose their investment credit rating? Are they going to dilute shareholders? Are they going to, look at alternative financing, look at maybe sovereign wealth funds? I think there's a lot of options on the table, and I don't know that they're going to give a very definitive answer, but I think they can do a lot on the earnings call in that hour to really calm fears that there's not going to be a huge delay in the recognition here, that the margins on this deal and on similar AI deals are in fact something that's going to be accretive to profitability over, call it, the next 5 years.
Rishi, I guess we knew that Oracle was offloading Ampere to SoftBank, and the idea behind Ampere was chips sort of designed specifically for AI. This is a departure from what we see the big hyperscalers doing, who I know Oracle would like to be held in the camp of, at a time when there are already questions about what kind of margins Oracle is going to be able to get out of its data center strategy long term. How are you modeling what they're going to be able to do, especially given how successful their hardware strategy was in another era when it raised eyebrows?
Yeah, look, I think it's a great question, and one that we need to ask, because as you correctly pointed out, all the other hyperscalers, Amazon, Microsoft, Google, are all designing their own AI chips and using third-party vendors alongside that. And I think the rationale there is to reduce dependency on NVIDIA over time. And, obviously that can have near-term implications, but over the long term, no one wants to be all in on AI infrastructure and only have one supplier behind that. Oracle, I think they recognize that all the fortunes here are very much dependent on them being a big vendor or middleman of choice around these NVIDIA chips, their close partnership with NVIDIA and with Jensen. And I think that's why, right, is just kind of calming those fears that Oracle would design something competitive with NVIDIA. And I think that's why they're doing that. So not surprised to see that, just given I think Oracle does have a higher degree of dependence on NVIDIA than others.
Okay. Rishi Jaluria, thank you.
Thank you.
Well, Synopsys also reporting results. The stock rising here in overtime. We're about to talk to the company's CEO, ask him about the numbers, the latest on U.S.-China chip export rules after the NVIDIA news earlier this week. Overtime will be right back.
Welcome back to Overtime. Shares of AeroVironment getting hit hard today after missing on earnings. You can see their shares finished down about 13%. The military drone maker did post record sales, inline guidance, at least on the revenue side. There may be some profit taking here as the stock has done well this year. It's up 60% even after today's drop. The other thing I would note, John, is some of what's in this report is government shutdown and the fact that higher margin foreign military sales were delayed. So expect that to start to roll out next year. An important caveat. All right. Meantime, Synopsys shares are up 7% in overtime. Joining me now in a first on CNBC interview, Synopsys CEO Sassine Ghazi. Sassine, the numbers overall looking good here. And of course, you got Ansys as part of the picture now. Last quarter, a lot of talk about the IP business. So tell me, is that getting any more predictable? And how does that affect not only this quarter, but how you're looking at the coming year?
Hey, John, great to be here. Yes, for Q4 and the FY26 guide, you can look at it as a combination of meet and beat on the top line and bottom line, which is very exciting. As far as Q3, we did hit a bump with some of the China restrictions. We could not sell to China for about 6 weeks, which is half the quarter, and it had an impact on our IP business in particular. But as we look ahead, we're continuing on de-risking China, and we're taking this as part of the guide for FY26.
So how should investors understand that? Because we got some news this week that sounded like relatively good news on China when it comes to chip restrictions. And one might think, oh, well, that could be good for Synopsys. But then again, the wind has a way of changing direction rather quickly these days.
Yeah, so you're referring to the NVIDIA H200, I'm assuming.
Yes.
Yeah, which is very good news. And the reason it's very good news because the more you can build the AI stack on the foundation silicon that is US-based, like the NVIDIA or AMD or whomever, it's good news because it has stickiness to it. Because the more you develop software on the hardware layer that the US provide is good news. From a Synopsys perspective, NVIDIA, of course, as they're designing the H200 or whatever chip they're shipping, it's using Synopsys technology. Now, inside China, the race is on. There are many companies that are developing alternative chips. And if these companies are not under government control or restrictions, we can sell to. But increasingly, these companies, we cannot sell to them. And they're trying to find local alternatives to design these chips.
So what do you do about that? And how long before that becomes a problem and a ceiling to growth? Are there other ways that you can expand into various other markets and blunt the impact?
Exactly. So that's how we're looking at it. For FY25, our business in China was declined, was down about 20+%. So as we're looking at FY26 guide, we're assuming the environment in China is not changing, meaning we're not guiding or taking into account in our forecast an uplift in the market in China. So we're taking a more balanced, pragmatic view. However, the increase in investment in chip design and now with the Ansys portfolio increasingly at the system level across the globe, in the US, in South Korea, in Europe, etc., we're seeing a very nice tailwind that is making up for the headwind that we're assuming in our guidance for China.
How much momentum potentially comes out of that Ansys acquisition sooner, given that digital twins, the ability to really model what impact a design will have on operations is now very much in your portfolio. Are you finding that customers around the world are leaning into that kind of investment, or is it going to take more time for that to materialize?
John, I know you and I discuss this topic quite often. If you believe that the future of AI is going to move to the physical world, meaning an intelligent car, robot, drone, and many applications, aerospace, etc., you need a more sophistication in designing these complex products. Therefore, you need more use of the Synopsys Classic, the semiconductor, as well as the ANSYS portfolio in order to create a digital twin to be able to simulate in order to reduce the cost, improve the time. Most of these markets traditionally have engineered these products through physical prototyping. You know that's expensive, that takes time, it's not intelligent, does not take into account an AI-powered product, more software content. And that's where we see significant opportunity. And that's where the endorsement of NVIDIA a couple weeks ago is a validation of that direction.
It's tended to be a nice endorsement indeed. Sassine, thank you. With the stock higher by more than 5%, let you get ready for that analyst call. Thanks for joining us first on CNBC.
Thank you, John.
Well, it's time now for a CNBC News Update with Bertha Coombs. Bertha.
Hey, Morgan. President Trump says Ukraine requested he meet with his Ukrainian counterpart Volodymyr Zelensky. He said Kyiv requested a meeting over the weekend in Europe and that he would make a determination based on what Ukraine comes back with. Zelensky said earlier today that Kyiv would submit an edited peace plan to the U.S. today. Canada has launched a $1.2 billion initiative to bring leading researchers to the country after the U.S. started charging $100,000 for new H-1B visa applications. Canadian officials say the funding will be used to attract and retain more than 1,000 highly skilled workers, such as doctors and scientists. And YouTube is making a move to unbundle the cable package. The company announced today it will unveil 10 genre-based packages to customers starting next year in a bid to let customers tailor their subscriptions. YouTube did not share pricing or what the plans entail, but said one will be geared towards sports and reportedly another towards family viewing. Of course, you know, there are cable providers like Spectrum that are actually bundling all of the streaming into their offerings. So there's a lot of war here in terms of bundling.
All right, 2.0. We'll keep watching it. Bertha Coombs, thank you. A big day for the markets following the Fed decision. The Russell 2000 jumping to an all-time high. So is the S&P Mid-Cap Index. We've got much more on the markets coming up.
And Bank of America CEO Brian Moynihan joins us after this break. The Fed seems to be turning its attention from fighting inflation toward boosting the economy. Does he agree with the Fed's approach? Overtime will be right back.
Welcome back to Overtime. A big day for the markets with the Dow gaining nearly 500 points. That's following the Fed's decision to cut interest rates and policy decisions outcomes that were seen as more dovish than expectations. The S&P 500 finishing just a few points shy of a record closing high. The Nasdaq up 1/3%. We did see a record high for the Russell 2000, the small caps. The Dow transports jumping nearly 3%. Truckers such as Old Dominion and J.B. Hunt leading the way, but airlines including Alaska Airlines and Southwest also seeing big gains. Shares of Oracle sinking in overtime, though. Those earnings were 62 cents per share. That was better than expected. Revenue did come in a bit light. Its software unit was one culprit for that revenue miss. Those shares are down about 7% right now. Planet Labs, those shares are doing the opposite. Those are soaring here in after hours, up 14%. The satellite imaging company and AI-enabled analytics company had a break-even quarter compared to the estimate for a small loss. Revenue was also better than expected, also came in at a record. Revenue guidance seen ahead of forecasts as well. And the company says its backlog is up more than 200% from last year. I did speak with co-founder and CEO Will Marshall over the weekend. You can check out that interview from Planet Labs on CNBC.com.
Well, the major averages are ending the day higher after the Fed cut interest rates for the third time in a row, which might be a tailwind for bank stocks. One of those stocks is Bank of America, up double digits this year, outperforming the broader market. Leslie Picker is at Goldman Sachs Annual Financial Services Conference, and she joins us now with Bank of America CEO Brian Moynihan. Leslie.
Hey, John, thank you. And thank you, Brian, for joining us today. An important day from a macro standpoint as well as from an industry standpoint. The Fed, of course, cutting for the third time this year, but indicating that preemptive easing is done. Based on what you're seeing in terms of the labor market, in terms of inflation, do you think this is the right call?
Well, I think let's separate those two things because they're two different things. So our team, our research team, which is the best there is, came to Fed cuts later than everybody else because they really believed the inflation was the issue. What got them there was the labor market softening. And so they didn't think the Fed, they still were of the opinion the Fed may not cut rates today, a couple weeks ago. So they came to this last cut. So, but they do believe they cut a couple more times next year, and they bring it down to around 3%, round numbers, 3.25%. And the reason why is the softening of the labor market. So it's not like people are, new claims for unemployment shooting through the roof or continuing claims. It's just that when you watch the numbers of people being reported being employed, the job formation is low. And so that's going to be on their mind because they have that dual mandate and they have to make sure unemployment's moved up to 4.4, which is still low in a relatively historic context, but is moved from 4.1 to 4.4. So our team thinks that they cut a few more times by the data they'll see between now and then. Meanwhile, the consumer's in good shape. They're spending money. Your team had Liz Everett on earlier, and she does a great job describing it. And when you look at the broad base of what they're doing, about 4% of the money year over year, November went in the economy. The consumer's healthy. There's money in deposits. It's a little bit, they were talking about K-shape or alligator shape. They had all different points, but a little bit faster, the upper tercile of income versus the lower. But it's all healthy. They're all growing. They're not growing fast, and they're worried about affordability and all the things you report on and talk about. But the reality is the consumer's in pretty good shape. If that continues on, then that might put more purchase power into the economy, and that might be inflationary. But that'll change quickly if they believe their jobs are not strong. And when we look at our data, we're not seeing unemployment move a lot, but we're not seeing a lot of people adding employees because we can see the paychecks coming.
Yeah, how do you square all of that? Because if the labor market looks kind of bad enough to justify a cut here and potentially some more cuts next year, but the consumer is still spending, do you see a tipping point where that kind of inflects and you start to see maybe some deterioration in the labor market affecting consumers in a bigger way?
Well, we haven't seen that yet. And that's what they have to watch out. But one of the things they got to get the official data out there, then everybody will have a more common view. So whether you see the ADP data or data like our firm puts out and stuff, you see a little bit running to stay in place on the labor market. You're seeing not a lot of job formation. You're seeing the numbers of jobs slow down. But the question is whether that's temporary around just because of the dynamics at the end of the year, people setting their budgets for next year, people start to think about will AI have a big impact or not? Maybe I should slow down my hiring anticipation. But I think you got to see it sustained. And I think our team believes that sort of weakness on the labor side will continue to cause them to reduce rates next year. But again, we get in this great debate about a quarter here or a quarter there. But if you think about it overall, there's not a lot of debate about getting it down around 3%. But no lower. People have to focus on, because that's a different rate environment that will have a 3% round numbers plus or minus Fed funds rate and a 4.5% 10-year Treasury rate. That's a real rate environment with a real, a steepness of the curve. We had an inverted curve for a number of years now, but also it's been since before the financial crisis that we had a rate environment that predominated at that level, except for the narrow period in 17, 18, 19.
Yeah, and that's what I was going to kind of pivot toward your business and what that might mean for your business from the standpoint of loan demand, of financing demand, because against that backdrop, you have, markets near record highs. You've got kind of this risk-taking appetite with M&A coming back, IPOs coming back. How does all of that factor into your business, especially given, some of the uncertainties that are out there as it pertains to labor?
So I'd sort of the consumer, small business, medium-sized business clients away from the capital markets oriented clients, because there's a whole lot of discussion there, and look at it in two parts. So if you look at the consumer spending, we talked about it, money in accounts, credit quality good, equity in our home strong, a lot of good fundamental things. That's going to come down to labor and wage growth. If you look at small businesses, they're doing a pretty good job of earning money. But on their mind is labor availability, which is kind of interesting when you think about the Fed's question. So can we get the labor availability up so they can have people to work and do a good job with it? Then you go to mid-sized clients, and what they're doing is you're seeing they're not using their lines of credit quite as active as they did pre-pandemic. If you think about that, what would be the condition if you borrowed at 40% average uses, then you're borrowing at 35, 36? That means you're not as aggressive and the cost of borrowing went up. So as rates come down, that'll favor the small business, middle market borrower because they borrow off of short-term rates, and that'll be good, and that'll probably have them be slightly more aggressive. When you go to the market side, the IPO market is opening up. The private equity firms that have businesses they've held for a long time, they need to sell them, so you're seeing some strategic activity go on. You're seeing some large mergers that you talk about all day long in your shows. But, there's a lot of activity. But I think if you think about that, that's going to take a good environment, and we think the economy grows at 2.4% next year. That's an environment where deals and things should take place.
And strategically, what does that mean for Bank of America? I know you had your investor day about a month ago. And yesterday, we heard some guidance from one of your biggest competitors, JP Morgan, Marianne Lake there providing guidance on expenses yesterday that surprised the street, at least temporarily. It bounced back a bit today. How are you thinking about their increased expenses in the context of what many analysts are describing to be this uniquely competitive environment for the banking industry?
With 4,000 people competing in the banking sector, then the non-bank sector, then the private equity funds and the private capital funds and the fintech and all this, there's been lots of competitors. So I don't think that changes. I think at the end of the day, as we think about expenses and thought about it across time, the first way we can manage expense growth the most is about people, headcount. And we manage that very carefully because what we always are trying to do is make our processes more efficient and take the savings out of that and plow it into the front end, client development, both people, products, new technology capabilities. So if you think about over the last 5 or 6 years, our headcount looks like it's relatively flat, but in that process, we added 4,000 technology coders. We added 2,000 people in the relationship management business going out in the field and covering clients. So you're adding people, but what are you doing? You're engineering out other processing capabilities. And as a management team, our team has the task of managing the human being aspect of that. So we have about an 8% turnover rate a year. That's 16,000 people. If we hire 14,000, we go down 2,000 people. So we have opportunities to shape the headcount, but you got to be ahead of it and do it. Our expense growth rate, I told the analyst earlier, was year over year, 25 to 20 over 24 was about 4.5%. Fourth quarter, we said it's year over year, it's about 4% plus. But if you add back, we had a credit from the FDIC, all of us got last year, fourth quarter, it's like 2.5%, 3%. In a 2.5% to 3% inflation environment, that's pretty good management. But you have to be on the process of engineering. We're investing a ton in the front. I mean, literally, we have, we're up to about $4.2 billion in annual initiative technology spend. This isn't the base. The base is $10 billion. This is just to put new products out there. And we're investing in people all over the world in our international business, local business, salespeople. So you got to have that. The nature of our business is there's 4,000 competitors. So if you look at across long periods of time, the competitive nature of the industry has had us make it the same sort of returns across time, even though the return on assets in our industry has come down, because the competitiveness leads you to giving that to the customer.
Real quickly on the competition side of things, reports indicate you're scheduled to meet with senators from both sides of the aisle to discuss crypto legislation, particularly this idea of allowing interest payments on stable coins. What would something like that mean for the traditional banking industry?
Well, I think we're meeting more broadly about the issues that affect us at stable coins and making sure they get the other parts of the legislation passed, and which we got to make sure if you're going to have an industry, it's got to have great structure to it. And it's got to have great industrial strength to it in times of stress. It's got to have an understanding of how the market, what they call the market infrastructure works. We don't think twice about DTC and stock trades, and they just go on all day, and billions of shares trade, and billions of quotes are quoted. We don't think twice about it because that's been added for a lot of years. It used to be paper, go down the floor exchange, all those people run around now. There's very few people, and it's automation. So the question of getting that market structure right is a critical thing, and we got to get it right, because if there's a bounce in this and it's a new technology, people may walk away from it, and that's what we want to make sure it's set up right. And so whether there's interest paid and this stuff, we got to make sure that especially small, medium-sized banks are not disfavored by this type of activity. We as Bank of America, we can compete with anybody, but you want to make sure deposits don't flow out to go to only be able to buy treasuries or cash, which, if you look at the money market funds, $6 trillion cannot be lent. So the only borrower for that amount of money is the federal government. Mm-hmm. And I think we ought to calm down the federal government's borrowing and have them borrow less. But if you think about it, you don't want to take a bunch of deposits and move them outside the industry in a way that doesn't allow them to be relent to generate small business loans. We're the largest small business lender in the country, not by a lot, and have been for many times. We're the largest small business lender in most markets out there. We're very proud of that. We drive that. That's what you want those deposits to go to.
Yeah, certainly an area to watch. Brian Moynihan, CEO of Bank of America, thank you so much for joining us today. Guys, I'll send it back to you.
All right, thank you. Leslie Picker, to you as well. Coming up, the latest developments on the battle for Warner Brothers Discovery. Overtime, we'll be right back. Welcome back to Overtime. We got an update on the battle for Warner Brothers Discovery. Julia Borston has that for us. Julia?
Well, we've seen a letter from Paramount Skydance, which has just gone out to Warner Brothers Discovery shareholders, urging them to accept the $30 per share tender offer. Some key notes here in this letter. The letter says to suggest we are not good for the money or might commit fraud to try to escape our obligations, as certain reports have speculated, is absurd. They go on to say that absurdity is underscored by the fact that Warner Brothers Discovery and its advisors never picked up the phone or typed out a responsive text or email to raise any questions or concern or to seek out any clarification. They go on to say, for the avoidance of doubt, our $6 billion synergy estimate does not rely on cuts to content budgets at our studios, and they intend to continue running both separately post-close. They say those synergies will be from technology, linear networks optimization, and real estate rationalization. They also criticize Netflix's strategy when it comes to regulatory approval, saying Warner Brothers' transaction with Netflix appears to be in for a long and bumpy ride as it navigates the global regulatory review process. They say that the argument being advanced publicly by Netflix and its proxy states that regulators should ignore the streaming video on demand market and instead utilize a gerrymandered market definition that includes services like YouTube, TikTok, Instagram, and Facebook. Going on to say Netflix's claim boils down to trying to mask its dominance in streaming video on demand by grouping together all internet-enabled video media and social media or otherwise, saying no regulator has ever accepted such a broad approach to market definition, and to do so would require regulators to give up on merger enforcement in media and social media alike. Quite harsh words here in this letter that Paramount Skydance is sending to Warner Brothers Discovery shareholders, urging them to tender their shares. And we will reach out to the parties for comment, especially the criticism of the regulatory potential. Back over to you.
Yeah, it's super fascinating, especially when you see shares of Paramount up more than 1% on this reporting. Julia Borston, thank you. Up next, we will discuss whether the Fed's latest rate cuts could spark a December to remember year-end Santa Claus rally.